We will now cover income under the head income from house property. First, we look at the basis of charge and computation under this head. What is charged under the head income from house property? The annual value of property of which the SSE is the owner and which is not occupied him for business or profession carried on by him is chargeable to tax under the head income from house property. Property means buildings or lands appurtenant thereto. As far as income from vacant land is concerned, it is taxable under the head PGBP or IFOS but not under the head IHP. Where the SSE is not the owner of the property, income is not covered under the head IHP but under PGBP or IFOS. Where the property is occupied for business or profession, PGBP comes into play and IHP is not relevant. However, where property is held as a stock in trade, then that is taxable under IHP. As far as farmhouse used for agriculture is concerned, income therefrom is exempt as agricultural income, which we have seen in the topic on exempt incomes. We now look at the types of properties. The property can either be LOP or SOP or UOP or DLOP. A property which is let out is treated as let out property or LOP. A property which is in the occupation of the owner for his own residence is called SOP or self-occupied property. If there is a property of which the SSE is the owner, but the SSE cannot actually occupy that property. Why? Because due to his employment, business or profession, which is carried on at some other place, the SSE cannot actually reside in that property and he has to reside at that other place in a building which does not belong to him. So that's why the property remains unoccupied. So that is called unoccupied property or UOP. Now both for SOP and UOP, where such property consists of up to 2 houses, the classification is that of a SOP or UOP. But where such property consists of more than 2 houses, then the SSE can specify up to 2 houses at his option as SOP or UOP. As SOP or UOP, and this option can be changed every year. For the other houses, that is, for the houses which are more than 2, for the other houses, the treatment is that of a DLOP, which is deemed to be let out property. So even though the property is not let out, it is deemed to be let out, and that's why it's called DLOP. As we noted above, property which is occupied by the owner for his own business or profession, it is not covered under IHP in the first place. Now, as far as SOP or UOP is concerned, self-occupied or unoccupied property, where the property or any part thereof is let during the previous year, or maybe any other benefit is derived from such property by the owner, then the classification is changed from SOP or UOP to that of a LOP, and the tax treatment applies as that which applies in the case of a LOP. We now look at the master chart for computation of income under the head IHP, and these are the steps to be followed. The computation is different for LOP, for SOP or UOP, and for a DLOP. So first we look at the computation for LOP. In step 1, we compute the expected rent. And expected rent is the higher of A or B, A fair rent or the municipal value. But this is restricted to standard rent, so this cannot exceed the amount of standard rent. In step 2, we compute the actual rent. This is what? This is the rent received or receivable during the year minus unrealized rent. Minus unrealized rent. In step 3, gross annual value is computed, GAV. It is the higher of expected rent or actual rent. But there may be a case where the property is let out and there is a vacancy, and if certain conditions in that case are satisfied, then vacancy allowance is available, as per which the gross annual value GAV is not the higher of expected rent or actual rent, but GAV is equal to actual rent. We will look at that. From the GAV, in step 4, we deduct municipal taxes actually paid during the previous year by the owner. That gives us the amount of NAV or the net annual value. From the NAV, we allow deductions provided under section 24. And there are two deductions. One is on account of standard deduction, which is at the rate of 30% of NAV, and interest on borrowed capital to the full extent. And that gives us the income under the head IHP, which can either be income or loss. For SOP or UOP, the NAV is taken as nil. So we straight away jump to step 5 and we take NAV as nil. Consequently, standard deduction becomes irrelevant. What is then allowed is only the interest on borrowed capital, and there is a limit of either 30,000 or 2 lakh. So that results in a loss under the head IHP. Now DLOP, as we have noted, though the property is not a let out property, but it is deemed to be let out property. So therefore the computation is same as that of LOP. The computation is same as that of LOP, but the only difference is while computing GAV. So GAV in the case of DLOP is not the higher of expected rent or actual rent, because there is no actual rent in the case of DLOP, and therefore by default the GAV becomes the expected rent. The other steps remain the same as that for LOP. Now sometimes the property will come into existence during the previous year. So that means the property will not be in existence for the whole of the previous year. In that case, we need to keep in mind that the annual value should be computed only for the proportionate period. That means for the period the property is in existence. The date property comes into existence till the 31st March of the previous year. That means expected rent and the actual rent, and consequently the GAV. But the other values, that is deduction on account of municipal taxes and interest on borrowed capital, standard deduction, will be allowed in full and not proportionate. Now we look at each of the items which we have discussed in the master chart. So first we compute GAV, and for GAV we need to find out the amount of expected rent and the actual rent. So what is the expected rent? As we noted above, it is higher of fair rent or municipal value, but it cannot exceed the amount of standard rent. What is fair rent? Fair rent is the rent from a similar property in the same or similar locality, and in the question it may also be referred to as reasonable rent. What is the municipal value? It is the value determined by the municipal authority for levy of municipal taxes on the property. What is the standard rent? It is the rent which is fixed under the Rent Control Act of the relevant state. Then we determine actual rent, which is actual rent which is received or receivable by the owner during the previous year. And consequently, we compute GAV, which is what? Which is the higher of A, expected rent, or B, actual rent. Now, as we noted above, actual rent does not include the amount of unrealized rent. So while computing actual rent, GAV is higher of expected rent or actual rent, but actual rent excludes the amount of unrealized rent. What is unrealized rent? Rent which is payable, but it has not been paid by a tenant, and it is proved to be lost and irrecoverable where 4 conditions of Rule 4 are satisfied. Number 1, tenancy is a bona fide tenancy. Number 2, the defaulting tenant has vacated the property, or steps have been taken by the assessee to compel him to vacate the property. Number 3, the defaulting tenant is not in occupation of any other property of the assessee. And number 4, assessee has taken all reasonable steps to institute legal proceedings for recovery of rent. If that is not the case, then he has satisfied AO that legal proceedings would be useless or worthless. If these 4 conditions are satisfied of Rule 4, then unrealized rent is deducted from actual rent, otherwise it is not deducted from the actual rent. We have noted above in the master chart that vacancy allowance is also available in certain cases. Normally the GAV is higher of expected rent or actual rent, but where vacancy allowance is available, then GAV is equal to actual rent. This is applicable when the property is let and is vacant during the previous year. In that case, we need to follow 2 steps. Step 1, we compare the actual rent with the expected rent. And actual rent is what we determined after reducing unrealized rent, if any, if the conditions of Rule 4 have been fulfilled. Then, if the actual rent is less than the expected rent, but owing to vacancy, in that case vacancy allowance is available and GAV is equal to the actual rent. So vacancy allowance is provided where actual rent is less than expected rent only due to vacancy, not on account of any other reason. If vacancy allowance is not applicable because this condition is not satisfied, then GAV is computed normally, which is what? Which is higher of expected rent or actual rent. So once we have computed the amount of GAV, then we deduct municipal taxes which are actually paid during the previous year. By whom? By the owner. And these are deducted from the GAV to arrive at what? At the net annual value or NAV. And municipal taxes also include the service taxes which are levied by the local authority, like what? Like sewerage tax, water tax, etc. After we have computed NAV, we allow for deductions under section 24, and there are two deductions. The first is standard deduction under section 24A, and this is equal to 30% of NAV. This is equal to 30% of NAV, and this subsumes all the expenses. Therefore, no separate deduction is allowed for expenses like repair and maintenance, insurance premium, electricity, water, etc. Only standard deduction is allowed. The second deduction under section 24 is under section 24B on account of interest on borrowed capital. What is the quantum of interest? Interest payable on borrowed capital is allowed as a deduction where property is acquired, constructed, repaired, renewed, or reconstructed with borrowed capital. 5 cases. Where the property is treated as LOP or DLOP, the interest payable on borrowed capital is fully deductible, there is no limit. But where it is a case of SOP or UOP, up to 2 houses, then there is a limit. Why up to 2 houses? Because beyond 2 houses, the property will be treated as DLOP, for which there is no limit, interest is fully deductible. So for up to 2 SOPs or UOPs, there is a limit. And it depends on for what purpose is the amount borrowed. So where the property is repaired, renewed, or constructed, that means number 3, number 4, and number 5, then the deduction is allowed up to a maximum of 30,000. Okay. Beyond this, if interest is payable, it is not allowed as deduction. If the property is acquired, number 1, or constructed, number 2, with borrowed capital. So out of these 5, number 3, 4, 5 are covered here, deduction 30,000, and number 1 and 2, acquisition or construction, is covered here. In the case of acquisition or construction, it depends on when is the capital borrowed. If the capital was borrowed before 1st April 1999, then the deduction is limited to 30,000. But if the capital is borrowed on or after 1st April 1999, then an enhanced deduction limit of 2 lakh is available, but only if 2 conditions are satisfied. The first condition is that the acquisition or construction of the property should be completed, not started, completed within what? Within 5 years from not the date on which the capital was borrowed, but from the end of the financial year in which capital was borrowed. And the further condition that needs to be satisfied is that the SSE should furnish a certificate from whom? From the lender, specifying the amount of interest. If both these conditions are satisfied, then the interest is deductible up to the extent of 2 lakh. If both these conditions are not satisfied, then the limit remains at rupees 30,000. Now the aggregate deduction for SOP UOP cannot exceed 2 lakh. That means if there are 2 properties for which say for one deduction is allowed of say 30,000 and for another deduction is allowed of say 2 lakh. So 2 lakh 30,000 cannot be claimed as deduction because the overall limit cannot exceed 2 lakh. 2 lakh will be allowed as deduction for both these properties. Now there may be a case where the SSE takes a new loan to repay the original loan, and then the SSE would pay interest on that new loan. So that interest on that new loan will also be eligible for deduction as per the above said limits. Now interest which is deductible as per the chart above, which we just now saw, is not just the current year's interest, but also the prior period interest. Current year interest for the current previous year, prior period interest for the preceding previous years, which was not allowable as a deduction because the property was not in existence in that year because construction was ongoing, for example, and therefore the property was not in existence, and therefore the income was not taxable under the head IHP, and consequently no deduction was allowed for that prior period. But now when the property gets acquired or when the construction gets completed, now prior period interest becomes deductible. So what are the steps? Step 1. First we compute prior period interest. What is the amount of prior period interest? We compute interest for a particular period. For what period? For the period prior to the previous year in which property is acquired or constructed. So that is the prior period interest. That means we start the computation of interest from the date of borrowing, and we end on 31st March immediately preceding the date of completion of acquisition or construction, which is prior to the previous year of acquisition or construction. That is the prior period interest. And then we deduct this prior period interest in 5 equal annual installments. And the first year of deduction is the previous year in which property is acquired or constructed, and 4 subsequent years. So ultimately, we deduct not only the current year's interest but also the prior period interest. What you need to note is the prior period interest is deductible only when loan is taken for acquisition or construction, not for other purposes. And prior period interest is deductible whether the property is LOP, DLOP, SOP or UOP, it doesn't matter, but the loan should be taken for acquisition or construction. Now interest under section 24B is deductible not on payment basis but on due basis. Expenses like brokerage, commission, etc. for arrangement of loan are not deductible. Only interest on capital borrowed is deductible. What about repayment of principal? 80C deduction can be claimed in the terms of that provision. Certain interest may not be deductible under section 24B because there is a limit of 30,000 or 2 lakhs. So entire interest may not be allowed as deduction. What about that? That unabsorbed interest, it can be claimed as deduction from the gross total income in terms of section 80EEA. We will now look at certain special situations. So as we noted some time back, where there are more than 2 self-occupied or unoccupied properties, only up to 2 properties can be specified by the SSE at its option as SOP UOP, and the others are treated as DLOP, and therefore the SSE will be required to make the selection. What are the steps for selection? In step 1, we compute income from each property assuming it is SOP or UOP. So for all the properties, we make the computation like this. In step 2, we make the computation for each property assuming it is DLOP. Then in step 3, we create combinations of properties where in each combination we take any 2 property as SOP or UOP and we take the others as DLOP. And then we compute income under the head IHP for each such combination. In step 4, we select the combination with the minimum income which is taxable under the head IHP, that is the most beneficial to the SSE, and accordingly we, depending on the selected combination, we earmark the 2 properties as SOP UOP and the other properties become DLOP. Now when we are making this computation for these combinations, so in respect of SOP UOP properties, when we are allowing the deduction in respect of interest, we should ensure that it should not exceed the limit of 30,000 or 2 lakh as the case may be. Now there can be a case where a self-occupied or unoccupied property is let out during the previous year, or say any other benefit is derived by the owner from such property. So as we have noted some time back, in such case the property ceases to be classified as SOP or UOP and it is treated as LOP. Consequently, the benefit of nil NAV is not available and computation of such property is made as if it is LOP. Therefore, all the values are taken for the whole year. For the whole year, because treatment is that of a LOP. But as far as actual rent is concerned, it is only taken for the let out period, because it can only be taken for the let out period. What happens where a portion is used as SOP or UOP and a portion is used as LOP? In that case, we treat the different portions differently. So SOP UOP portion is treated as SOP UOP, LOP portion is treated as LOP, and computation is made accordingly. So therefore, the values are apportioned. Municipal value, fair rent, standard rent, municipal taxes, interest are apportioned based on the usage of portions. But obviously, actual rent should not be apportioned because it cannot be for SOP OP portion, it will only be for LOP portion. When we allow deduction of interest, it will be as per the limits. That means for LOP portion, there will be no limit of deduction, but for SOP UOP portion, the limit will be 30,000 or 2 lakh as the case may be. Sometimes the property may be owned by co-owners. It depends on whether the share of co-owners is definite and ascertainable. If that is not the case, that means their classification will be as an association of persons and income from house property will be taxable accordingly. But if their shares are definite and ascertainable, then income from house property will be taxable in the hands of co-owners. And it depends on the nature of the property. If the property is LOP, let out property, then first we compute income from the house property and then we apportion the income to the co-owners as per their respective shares. But if it is a case of SOP or UOP, then the income from house property is separately computed for each co-owner. And therefore, each of the co-owner is entitled to the benefit of nil NAV. Also, each co-owner is entitled to deduction of interest up to the limit of 30,000 or 2 lakh as the case may be. So 30,000 2 lakh limit is not the combined limit for all the co-owners put together. What we need to note here is where say a co-owner is owning a SOP or UOP which is other than this SOP or UOP which is co-owned. That means there are more than one SOP UOPs in that case. In that case, as we noted above, the overall interest deduction limit cannot exceed the limit of 2 lakhs. This is what we need to keep in mind. The SSE may receive arrears of rent or may realize unrealized rent in a subsequent previous year. In that case, this is deemed to be income from house property and it is taxable. In which previous year? In the year in which rent is received or realized. What if the SSE is not the owner of the property in that year? It doesn't matter. It is taxable. While computing such income, standard deduction is allowed to the extent of 30%, and therefore any expenses like on litigation, recovery expenses, etc. are not deducted separately. All that is taken care of by the standard deduction of 30%. Sometimes the SSE may not just let out the building. This will be a case where say there is a letting of building with services or letting of building with other assets like plant, machinery or furniture. In that case, a composite rent may be received. So where it is a case of letting of building with services, right? Then the rent needs to be split. Charges for services will be taxable under the head PGBP or IFOS as the case may be, whereas rent for building will be taxable under the head IHP. Where there is letting of building with other assets, plant, machinery or furniture, then we need to see whether both the lettings are separable or inseparable. Both the lettings are inseparable where the letting of one is not acceptable without the other. For example, auditorium is not acceptable without the furniture or air conditioning equipment. So where both lettings are inseparable, then the entire rent is taxable as PGBP or IFOS as the case may be. It need not be split. But where both the lettings are separable, then we need to split the rent. Rent for the building will be taxable as IHP and rent for the other assets will be taxable as PGBP or IFOS. In the case of real estate developers, they may hold the property as their stock in trade. A benefit is provided whereby the annual value of property is taken to be nil. But two conditions should be satisfied. The property should be held as a stock in trade and it should not be let during the previous year. In that case, the annual value of the property is taken to be nil. But this benefit is not open-ended. There is a timeline. It is available only up to 2 years from the end of the financial year in which certificate of completion is obtained from the competent authority. In certain cases, the transferor of the house property is deemed owner and therefore taxable on account of income from that property, even if the transferor is no more the legal owner of that property. There are certain situations, but we will discuss only one situation relevant from an exam point of view. And that is where an individual has transferred the house property to either his or her spouse or the minor child without adequate consideration, that is as a gift or for inadequate consideration. In that case, such individual transferor is deemed to be the owner, and therefore income from house property is taxable in his hands. But there are two exceptions. Number one, where the individual has transferred such property to the spouse in connection with the agreement to live apart. In that case, individual is not deemed owner. Second, where the transfer of property is to a minor child, being a married daughter. In that case also, individual is not deemed owner. Now there may be a case where instead of transfer of house property, money is gifted to the spouse or minor child, and out of that money gifted, they acquire the property. In that case, section 27 won't apply and individual will not be deemed owner. Rather, the income from house property will be taxable in the hands of the transferee, that is the spouse or the child, but then it will be clubbed back with the income of the transferor as per the provisions of clubbing.